Legendary investor Warren Buffett once likened those caught out by unpredictable investment markets to skinny dipping in the ocean. Only when the tide goes out do you discover who's been swimming naked, he said. Well, the markets have been unpredictable and the outgoing tide has shown up a lot of vulnerabilities. And perhaps the ugliest of all have been in the industry super funds. That's right, the union ALP money printing machines that have marketed themselves as having lower fees and superior returns has been caught a little overexposed. It turns out their superior returns is assisted by juicing up investment valuations on illiquid assets. In effect, they name the price they want the assets valued at, change their fees on the new higher valuation, and tell investors how well they've done. Let me give you just one example. 26 industry super funds own ME Bank, which is not listed on any stock exchange. The investment is revalued annually, and if it's like most banks, when the profits go down, so does the value of the investment. However, in the parallel universe of industry super, even when profits go down, the value of the illiquid asset goes up. In 2017, ME Bank's profit fell by 20%, but the value the super funds placed on ME Bank rose by 11%. It happened again last year. Profit dropped around 30%, but the revaluation increased by 5%. Now, ME Bank isn't some magical bank, but the valuations used by the super funds look to be magical indeed. And that's just one of many illiquid investment industry super funds put your money into. And it helps explain how they always seem to produce such good investment returns. As long as you don't peer too deeply behind the smoke and mirrors, it'll be okay, until it's not. And that's why when the government allowed early access to $10,000 of super due to coronavirus, the industry funds have been caught a wee bit short. They've been finding it a bit tough to give money back to its rightful owners. My guess is that they've been banking on a never-ending stream of money coming into their funds, driven by unions and slick marketing campaigns to pay out their existing obligations to superannuants. When coronavirus suddenly reversed the flow of money, the tide went out on industry super, and believe me, it's not a pretty sight. Well, Nicholas REECE, you've been a very strong supporter of the union movement and of industry super. What do you have to say in response to my editorial?
Well, industry super funds charge lower fees and earn superior returns for investors compared to the commercial retail funds. And that's just not me, Nicholas REECE, saying that. That's the finding of independent organisations who measure returns on people's retirement savings. And that's just not me saying it, Corey. That's the reason why millions of people have shifted from the commercial retail funds, shifted out of independently managed super funds and moved their money across to the industry super funds. I don't know if you're watching the Banking Royal Commission last year, Corey, but the industry super funds came out smelling like roses, and the banks and many of these commercial funds got a kick up the backside.
Did you listen to anything I just said? I explained exactly how they are juicing up the returns by revaluing illiquid assets. Now, that's the essence of it. You've just gone back to their marketing campaigns. You have to actually understand what they're doing. They're taking something that no one else can really value, going to a valuer and saying, we think it's worth this. And then saying, look at the returns that we've delivered for them. In actual fact, when the pedal's been put to the metal and they've asked people cash out, they can't get rid of these assets, they can't revalue them, and they've been caught short of cash. That's how they're rigging the system, Nicholas.
Corey, that is not financial analysis you're providing. That's not economic analysis. That's ideology. This is the culture wars. You're now waging the culture wars on Australia's retirement savings just because it was a Labor government led by Paul Keating that had the original vision for this model. Now, look, let's look at what's really happened here. The fact is, superannuation funds hold assets with a certain degree of liquidity based on what they forecast is going to be the amount of withdrawals that they're going to have from members. Now, when the federal government causes a run on super funds because they tell Australians that they can pull their money out of super tax-free, that's a force majeure which they could not have reasonably be seen to have foreseen. And you know what it does? Hang on. No, there's a really important final point here, Corey, and it's this. And you know who ultimately pays the price there? It's the members, because then the funds are required to pay out to members at the absolute bottom of the market when the market is basically tanked, all because the federal government, who have also embraced this culture wars against these industry funds, thought it was a good opportunity to use a crisis to have a whack at Australia's retirement savings in the form of industry super. That's what happened.
Before we go to Catherine, I want to say, at least you acknowledge the simple fact that they have been investing in illiquid assets. And the reason that's the problem is because they can revalue them. There's no market to revalue them. And you haven't had the same problems in commercial funds about redeploying cash because they've got liquid assets. Yes, if people choose to withdraw at the lowest point, so be it. But some of the industry super funds had virtually zero cash in reserves and were asking for bailouts by the government. Now, I think that's wrong. Catherine McGregor, what do you think about that?
Well, you talked about unlikely bedfellows, and I think anyone who's been watching Nick and I doing our Punch and Judy show for the last 4 weeks with Chris Kenny will be surprised. I thought that was one of the genuinely visionary things Paul Keating came up with, was the idea of trying to take some of the pressure off the Australian pension system by making mandatory through-life provision as part of salary packaging for employees. And I still think that. I also think, Corey, you're onto something, though, in the merits of your argument, particularly about ME Bank. Its behaviour was quite extraordinary. The stories that you read of people thinking they had drawdown capacity in their mortgages, which they were well in front of, and having it turned off with no warning was quite reprehensible, frankly. But we are dealing with the ultimate black swan event here, aren't we? The normal function of superannuation is that you don't expect everyone to draw on their super at once. So I think it was an unforeseeable crisis, but the broad principle of having people having direct contributions to their retirement earnings, it was a very sound principle when it was first implemented. The sadness over time has been, of course, that we've seen no real pressure come off the old age system because there are so many offsetting factors that the fact is that most people still qualify anyway, regardless. And I guess it behoves you and I, mate, as people in defined benefit schemes, to probably be a bit stum about this one.
Let me correct you there, Catherine. I'm not in a defined benefit scheme. I regret to say, and I'll also correct Nicholas before I go to Gemma, that I only spent 10 years working in... Hang on, I spent 10 years in the financial services industry understanding about superannuation and investment. So this is not ideology. This is about the risks attached to illiquid investments. Now, Gemma... Okay. You've got a long time ahead of you investing in superannuation.
A long time ahead of me. You'll go far. Oh, look, I think there's a couple of things. There's a couple of things at play. First of all, the ability to draw on one's super during this crisis. Look, I know of people who have genuinely needed to draw on their super and have done so without a lot of pleasure and reluctantly. But I also know some complete peanuts who've drawn on their super simply because they can, and they've done things like buy a new car, and in one case of someone I know, buy a DJing deck. I'm making that up. And I think you can't legislate against stupidity, and you can't have people... You know, the ability to be prudent with your own finances in a time of risk is not something that's clearly innate. The second thing, to your point, Corey, it's really concerning, but the reason that superannuation funds in general, be they industry-based or corporate, the reason they can get away with the fees that they charge or the investment profiles that they engage with is because they're banking on the majority of their customers believing the promise that is, we are trustworthy, we will look after your retirement. How many of us actually understand the investment profile of the super fund that we're involved with? How many of us actually ask the question? And that, as important as the points you've raised are, Corey, that's an important part of the puzzle as well, because who's watching them, right? We can't have a royal commission into the financial services sector every 30 seconds. We've all got a responsibility, every single one of us.
You're exactly right. I don't think most Australians understand that superannuation is simply a tax-effective environment. It's not an investment mix in itself. And
Right.
so that's why we need to make sure that people do understand they're financially literate, they understand the investments and including the liquidity issues if they need to get their money out quickly. But I just want to throw to Catherine.
Can I just add one more thing to that? Can I just add one more thing to that? I would have definitely fallen into that. In fact, I did fall into that category until about 10 years ago when my marriage ended and I was financially independent truly for the first time. And I can tell you that financial literacy for women is a huge, huge issue in this country that needs to be taken up. I've actually got a self-managed super fund, and I can tell you one thing, it's one way to educate in a hurry and become reluctantly sharp on these matters, because I couldn't find a fund that I was prepared to trust with my investment and my future.
Yeah. I'm keen to hear more about Catherine's line of inquiry about Corey Bernardi's superannuation arrangements, because we know when it comes to hogs at the trough, no one can beat the superannuation arrangements of the pollies. So tell us how hard it is for you, Corey, on the Australian federal politician super entitlement scheme.
One at a time. Let me just go back to this, Nick, to prove that you're still living in the Cold War, maybe the Korean War. Your defined benefit scheme, the defined benefit scheme you talk of, was abolished before I got into Parliament. So I'm just like every other public servant. I've been chipping away and contributing to it, suffering the slings and arrows of this market. But at least I had a self-managed super fund, so I understand it, Nicholas. I understand it. You've just demonstrated you don't. You aspire to get into politics, obviously for the super that's no longer there. So anyway, good luck to you.
You're telling
Catherine,
me, Corey,
what have you got
that
to
pulling
say?
that 10 grand... Pulling 10 grand out of my fund to go on the Ruby Princess in October is a dumb idea. Is that what I'm to take from tonight's discussion?
Oh, Catherine, you can do what you like. At your age, love, you can do anything you like. That's what I say. It's your birthday.
Corey, I'll happily put my knowledge of the Australian economy and financial system up against yours any day. I mean, you have cherry-picked one case study involving a infrastructure asset, I believe, and you've then tried to say that the entire industry super fund system is characterised that way. And you know that's not true. What really happened here was that the federal government wanted to play culture wars with Australia's retirement savings, and so gave people a tax-free opportunity to raid their super funds. And being rational beings, that's what people did, and they caused those funds to sell out at the bottom of the market, ultimately hurting workers' retirement savings as a result.
Liquidity into the system.